Welcome to today's Siegel Rogers Casey webinar, third quarter 2014 investment outlook update. Steady as she goes, but hold on to the railing. Today's presenters are Tim Barron, Senior Vice President and Chief Investment Officer, and John Ross, Senior Vice President and Head of Beta Research. I would now like to turn the presentation over to Tim Barron.
Yes, this is Tim. Thank you all for participating this morning. As is often the case, we've got a couple of our folks here to review the outlook going into the fourth quarter here 2014. John Ross, who heads the Beta Research, is going to begin with the summary of the global environment, and then after that's complete, I'm going to reflect that global environment look onto the asset classes themselves and provide a perspective on our thoughts on the capital markets. Remind the listeners that we do this quarterly, and the goal is to really look out 12 to 18 months and think about where markets might be and what might be the important economic factors influencing those markets over that 12 to 18 month period of time. So with that introduction, John, let me turn it to you.
Great. Thanks, Tim. So our third quarter update, expresses a nautical theme: steady as she goes, but hold on to the railing. We further state in that piece that the Fed Reserve Chair Janet Yellen, OMC, have set a course, at least for the U.S., that includes words and phrases many of us have become familiar with: slow, modest growth, moderate inflation, lower controlled interest rate increases. And while that might feel like the right course for the U.S. as we enter the fourth quarter, the global economy continues to show a few positive signs on the horizon, but also either a continuation or perhaps you could characterize it as of existing rough seas or a potential new storm front where previously there existed calmer seas. And luckily for all of us on the call, that's about the extent of my creative juices as it relates to a nautical theme. So I will not include any other nautical themes for the rest of my comments here. So first, in the U.S., we might finally be in a position to sustain some reasonable slow growth here path for the near future. After the unexpectedly kind of sharp downturn in the economy in Q1 of 2014, primarily driven by the severe winter weather, the growth here in the U.S. bounced back in Q2 and Q3, and think of it as kind of a more normalized path in Q3. However, real growth for the year is likely still to be in the 2 to 2.5% range. The Fed's supportive monetary policy has achieved, at least in part, the desired effects going in of directionally stronger job markets and improved balance sheets for both businesses and individuals. And that's been reflected in the form of greater net worth, higher home prices, higher stock prices, and also lower debt or deleveraging. The next well-documented challenge, I think, that we've seen as part of the approach is to support modest growth over the next several years without a sudden rise in inflation. And sudden, I think, is the key word there. So even though the Fed recently confirmed the anticipated end to its asset purchases in October, and my prior comments regarding job growth notwithstanding, we think there still does exist some weak indicators in both labor markets and inflation, wage inflation in particular, that will likely delay interest rate hikes until mid to late next year.